Welcome back to the IB Investor channel. In this video, we'll take a peek into Atlas Copco. Atlas Copco is a 140-year-old Swedish company and a pioneer in air compression technology. Today, the company is still the world's leading air compression manufacturer with around 25% market share. The company's product portfolio includes power tools, vacuum pumps. For vacuum pumps, the semiconductor chip cycle is a key demand driver. The company generates revenue from three sources: initial equipment sales, spare parts, and maintenance. It operates in more than 180 countries right now. The company is owner operated. It is owned by investor as a majority shareholder that holds 17% of the capital and more than 22% of the votes. It is one of the biggest companies in Sweden on the listed market with 612 billion Swedish kronor market cap. It offers a dividend yield at 1.85%, but it's a fast growing one, even though it's a little bit lower. The total return for the stock has been 23% CAGR for the past 10 years, considering the B shares. And total return is basically dividends reinvested into the shares. The company also offers a quite low net debt to EBITDA at 0.6 times. The company operates in more than 180 countries, so it has a very wide reach. The service business is very important for this company, and we'll take a deeper look into this in a few seconds. However, the service business in this company is so great actually that even Latour's previous CEO, Jan Svensson, once said that he wished that Assa Abloy had the same type of service business as Atlas Copco because it was so good. The company also has almost 52,200 employees as of the most recent quarter, which is the Q3 quarter for 2023. Now for a quick look on the share price return, and this is from my broker. And we can see here that the share price has really outperformed the indices here, and it's done great as of late as well. However, do mind that the stock probably would have done even better because in 2018, basically around this period here, they actually spun off a complete company called Epiroc, which is one large company in Sweden as well. So Epiroc used to belong to Atlas Copco. It was integrated into this company until 2018 then. So with that being said, obviously the share price would have probably been even higher today if that company would still have been within this umbrella. But we can also see here that the total share price return, excluding dividends here, has been more than 6,300, almost 6,400 during this period. But it is a cyclical company. We can see, excluding for this period, because we know the spun off, it's been cyclical. It's gone a little bit up and down. And even during the 2008 period, 2009 financial crisis, the stock actually went down along with many other companies. So it is a cyclical business, that's for sure. But do remember that the stock has returned roughly 23% total return CAGR for the past 10 years if we look at the B share. So really nice return for this company. Now, the service segments is a big part of the business for Atlas Copco, as mentioned before, and I think it's a great defense against the weaker sales as customers rather repair their compressors and so on, or other products from Atlas rather than probably buying new ones as they're quite costly. For example, a compressor, when I watched on the internet, can cost like $50,000 or even more sometimes. So I would assume that the customers rather want to repair them as much as they can before, buying a new one. And also here we can see for the different segments, they've been so nice here to actually tell us the percentage of the total revenues. We can see the service part here, for example, here for the compressor technique, we can see that 41% of the revenue is service, just for the compressor revenue. And here we can see the vacuum technique, 23%. So it's a little bit lower, but still it's a big part of the revenue, which is reoccurring then. Here for the industrial technique, we see 27% and also power technique at 44%, which seems to be the highest actually for the service margin here. So really good service. And we can see here some pictures. I mean, it's kind of hard to tell, but they're changing some filters here, probably doing some testing here to make sure that, everything works as it should. And it looks like they have their own staff actually going to these sites and changing them. much like Assa Abloy is changing, like keypads and so on. It looks like Atlas Copco are sending their own people to do the service here. So it's not just serving parts. It is also that they actually have their own maintenance managers or maintenance service people, engineers, actually fixing the machines and so on. Now for the free cash flow margin here, we can see that Atlas Copco has a 8.8% free cash flow margin in the most recent quarter here, Q3, but we can see it's gone down, up and down over this period. So it's not been super steady, but that's often the case with the free cash flow margin, but at least it's not been negative in any years during these past 10 years. And also as a comparison here, I selected Sandvik. It may not be the best comparison, but Sandvik currently sits at 5.4% free cash flow margin. In this picture, we can see the free cash flow per share in kroners, in Swedish kroners, and we can also see the trailing 12 months figure here at 3 kroners right now. So in my calculations then, that means that this company is trading at a free cash flow yield at somewhere like 2.4%, which is quite a low yield, I would say. Yeah, but it is what it is. And we can also see that it has been going up and down over the years. So, I mean, it is strongly correlated to the margin, of course, but it's still much higher than the 2022 per kroner this is. As we can see in this picture, Atlas Copco currently trades at quite a low yield, which kind of indicates that this company is not that cheap, I would say, and we've seen that the company has traded for quite a low yield for many years, actually. Comparing it to some peers here with Sandvik, that sits at 2.7% and ABB sits at 2.6%. So this company doesn't offer a very high yield, but it's a fast-growing dividend stock, as you will see on the next slides here, but 1.9% yield at least for this company. On this slide, we can see the dividends per year in kroners. So we can see here in the most recent year here, actually. So this is for the last year that they pay out this year. So that's why it's a little bit offset here, but they paid out 2.3 kroners a share. And we can see that they have increased their dividends quite nicely, but we have to remember that somewhere in 2018 they spun off a whole complete company, so obviously the dividends were going to be a little bit lower for the payout in 2019 from the year 2018. It's a little bit complex here, but the dividend has been increasing over time, which is good. And the latest dividend raise was 20% from this period to this period. So it is a dividend grower. And comparing it to Sandvik again, poor Sandvik, they raised their dividend by only 5%. So this is a much faster growing dividend stock compared to Sandvik, for example. Now this picture shows the enterprise value divided by the operating cash flows, and we can get the multiple done for this company at 26. So we can see that it's lower than it's been for the past 2 years at least, but comparing it to the previous periods here, where we see that it's been much lower, actually below even below 20 here for many years. So the valuations is quite high, I would say, for this company, but it is a high quality company, so it's probably worth paying up, but it's not cheap compared to its own history, so to speak, at least. And here we can also compare it to Sandvik that sits at 12.7 and ABB at just above 22 here. And again, this is the enterprise value divided by the operating cash flow multiple. If we look at the enterprise value to EBIT, we can see that it currently sits at roughly 18 times. And it's cheaper than it has been in the past, at least for the past 2 or 3 years here, or actually 4 years actually. So for this metric, it is actually looking pretty good even for historical levels, except for these periods here. But I think this was also one of the strategies that they wanted to spin off this Epiroc company, to unlock some value. So maybe that's also a reason why Atlas Copco recently has has gained some higher multiples here. But also comparing it to ABB, we can see that the EV to EBIT is quite a bit lower here for ABB, and also quite a bit lower here for Sandvik, comparing it to Atlas Copco's most recent quarter here. Now for the profit section of this company, Atlas Copco. So here we can see the gross margins. The gross margins are actually quite high at 43.2 for an industry company. We can see that they've been kind of sustainable for many years here. They reached this even in 2018. And comparing it then to Sandvik, that sits at almost 41%. So Atlas is just shy, a little bit better here. But Technion has actually better or higher gross margins here than Atlas Copco. And remember, fellow investors, that the company that we're reviewing now is not a tech company. We did check Evolution Gaming here recently, that sat at a 80% gross margin, but please do remember that this is a industry company which is more in line with normal standards, so to speak, on gross margins and not software margins. Here we can see the operating margin, and looking here, it sits at 21% or just above it for the most recent quarter, and it's been pretty sustainable at those levels actually, even past years. Even going back here, it's been roughly around 20%, I would say. So it is pretty sustainable. And remember, in the previous Technion video, that Technion had a gross margin of almost 47%, but here down below we can see that Technion only gets to keep just shy of 12% for their operating margin. So it's a kind of different business, I would say. Atlas Copco really gets to keep a lot of the operating margin here compared to Technion, and also compared to Sandvik, where it's always, what is it, 4 percentage points almost difference here. So Atlas Copco is clearly a winner here in terms of operating margins. And lastly then, for the final picture for the profit section, we can see that profit margin here sits at 16% for the most recent quarter, Q3 2023. It's been pretty sustainable for many years here. Nothing really dramatic, and we can see that compared to 2014, 2015, and 2016, the margin has improved, the profit margins then quite a bit, which is nice to see actually, that this company is becoming even more profitable as the years go. And we can also compare it here to the poor Sandvik company here that sits at a 11.5 profit margin, which is not bad, I would say. Please do remember that even a 11.5% profit margin, it's not a bad number. It's just that Atlas Copco is just so much better. We can also see ABB here, or ABB, that sits at 14.7. So the gap here is much smaller. It's only like, what, 1.5 or 1.6 percentage points difference here. So much smaller. But yeah, Atlas Copco is a very profitable company. Now looking at the debt situation here for Atlas Copco, we can see that they sit at 0.6 times net debt to EBITDA. Which is quite low. I mean, it's not negative, but it's low enough to have a flexibility to pounce on a bigger acquisition, for example, or making heavy investments going forwards within the company. And we can also see that it's been lower in the past. Actually, it's been quite low here, actually, even in 2017. But still, 0.6, it is a low figure, I would say, for an industry company. And comparing it then to ABB, which actually sits a little bit lower at 0.5, but then comparing it to Sandvik, which sits at 1.6. And please do remember that 1.6, it's not the end of the world either. Sandvik still has the possibility to probably expand their balance sheet here at 1.6 as well. Many companies can go at 2.5 as long as the cash flows are strong. Looking at this last slide here for this presentation, we can see that see how effective the management has been for this company. So this is basically the return on invested capital that we are looking at here, and we can see that it's been quite high for many years. I would say for the ever since 2017, they made something really great here, and we can see that the return on invested capital has just been crazy here. So double digits all across the board. So management have done an excellent job here to invest money and get really good returns and drive profits here. We can also compare it down to Sandvik, which has like half the return on invested capital compared to Atlas Copco, so way difference in terms of what kind of returns they're getting. ABB is a little bit closer here at 21%, so not too far away actually. But this proves that management has done a really good job allocating capital where they can drive profits further for the company. Now for some risk for this company, I think it's super hard as an outsider to know exactly what kind of attacks this company could be under from competition, because I think you need to know and understand the business much better than just looking at the financials. But at least the financials are the ones we can watch and make some assessments. And obviously the high profit margins here is one of those risks that I see, because the margins are really high. For example, the profit margins here at 16%. Any competitor looking at those margins will certainly look into Atlas Copco and try to figure out what they're doing so great, and they'll try to copy it to the best of their ability. If anything, they will try to take that market share and drive those profits the same way that Atlas Copco does, because I mean, who in the world wouldn't if there are peers within this field? So certainly that's something that management has to work hard for going forwards, to defend those margins at any point, because they are trading at good levels. That's what I can say. They have been pushing out the cost towards their customers in a good way, but they have to defend it every day. We also see high multiples here for this company, like the EBIT, enterprise value to EBIT at 18 times. It's not super expensive, I would say, but it's not dirt cheap. As you remember, the dividend yield previously was sitting at almost 1.9%, so it's not super high. I mean, it could go down a bit actually. So this indicates that this company could be a little bit overvalued. I mean, by the end of the day, you have to remember that this is actually a industry company, even though the profits are really good, or profit margins, but it is an industry company and it's probably cyclical as well. So, and that's a segue into the next topic as well, which is the orders received organically. That was down by 1%, if I looked at it correctly, from the most recent quarter. So that is something that shareholders or investors or potential investors should be a little bit worried about. But Atlas Copco is one of those companies that also acquires some growths. So it could be the case that potential lost sales could be offset by acquisitions. And as I mentioned before, the low net debt to EBITDA offers Atlas Copco's management to make acquisition in terms of offsetting some lost sales. So it is a little bit tricky, because management can do things here to offset a lot of these risks, but there are risks nevertheless. Now for the upside of this company, Atlas Copco is owned by one of the finest companies in Sweden, which is Investor. Investor is a financially strong owner with, they have global reach with many other companies other than just the portfolio company or companies that they have. And that means that the investor can open probably many doors for their portfolio companies, such as Atlas Copco, that the company otherwise wouldn't be able to get through. The management also has a good track record of allocating capital at very high returns, and we saw some slide here previously with return on invested capital that's sat at 23% and return on equity at 29.5%, which is very high. And most of it has actually been at those kind of levels for the past 5 to 7 years. So it looks like it is quite sustainable and not just a one-year thing. We also see that the company has a low net debt to EBITDA, which offers the possibility that Atlas Copco could, if they want, continue to fuel its growth through heavy investments or acquisitions or both, without risking the balance sheet too much here. And as I mentioned on the previous slide here, that they can offset much of the slowing growth in sales, for example, by making some acquisitions, even though it may not look like it's organically because it won't be the first year, but at least the sales will still come in and look like the company is still growing. This was it for this video. If you liked it, please hit the like button below and subscribe for more content. Thank you very much for watching. See you in the next one.